Hello friends, and welcome to this PwC webcast on the India Budget 2017. The budget in India is a very big event, not just because it's used as a platform for making announcements around tax changes, policy changes, FDI changes, apart from also just giving flavor on how the finance minister is balancing the books of this large country. Indeed, apart from being the largest democracy of the world, this budget touches 1/5 of the human race, apart from impacting investors from overseas who've invested over here. So every year, it does deserve the bit of, if I'll say, aura and the noise and the special focus that is given to it. Today, over the next hour, we have with us certain guests as well as some of my colleagues. And we thought we'll share with you our initial thoughts of what we heard and a little bit of what we've read in the past 4 or 5 hours. Let me first quickly introduce whom I have with me. Firstly, we have got a very special guest, Mr. Padmanabhan. Many of you may already be knowing him. He's spent about 35 years at the Reserve Bank of India before retiring in 2015 as the Executive Director. He's presently Chairman of a public sector bank. And in the various roles as he's had in the RBI, also included around the IT and the payment space and the digital space, which really is a lot of flavor of that in the budget today. Along with Mr. Padmanabhan, I have Abhishek Goenka, my colleague, who leads our direct tax and corporate tax practice for PwC in India, and also Dharmesh Panchal, who heads the indirect tax practice in this part of the country for us. We have space for Q&A at the end, so don't hesitate to shoot in your questions as we go along and discuss some of this. But to start off with, let me just summarize 3 or 4 themes that came to my mind as I sat through Mr. Jaitley's speech and went through quickly some of the fine print that we could in the limited time. I think one single biggest item that really struck you when you went through the budget is, without losing the focus on investment in both rural and infrastructure, which are really 2 key pillars for us, the finance minister has carefully made sure that he sticks to fiscal consolidation and has kept the fiscal deficit within the limited range. And this despite being given a bit of a freeway by the committee, which recommended that if you like, you can kind of pause the pace of reduction on the fiscal deficit. But as he said, he chose not to entirely take that liberty. So that, to me, was a big, if I'll say, summary of how the financial position looks like. The second theme, we've just come out of the demonetization impact, and we're ready to get into the GST. One big change, if you may have noticed already, is that the whole large parallel economy in this country has been pushed and nudged to move over and come into, so to say, the disclosed or the declared economy. Running throughout this budget is the theme of that nudge, that push, the carrots, which are inviting those folks of saying, come into what I may call tax inclusion. We've kept talking about financial inclusion, but this probably is the new buzzword. The third piece, of course, is when you get slightly more to details on the tax side, both some reason for cheer for the foreign investors in terms of clarification on the indirect transfer provisions. You may be aware, just after Christmas, there was this circular which kind of got a few of the foreign portfolio investors worried. And while that circular was kept in abeyance, we were expecting some changes around the budget and they have come. And while that's on the capital side, on the debt side, the continuation or extension of the lower withholding tax rates just meant that the government is keeping an eye and a watch on foreign inflow into the country, whether it's on the equity side in the listed space or, for that matter, the debt side. Before I move over to Mr. Padmanabhan, I recollect a phrase which was spoken by Mr. Palkiwal earlier, and it was, when it's not necessary to change, it's necessary not to change. And for that matter, things around inheritance tax, changes around the holding period for capital gains, especially on the listed side, I think the government has done well not to change things at this point in time. So with that, these 3 or 4 themes that I thought were pretty important takeaways of the budget. And if you put these together, of course, the budget looks more positive and contains more positives than the negatives. Yes, there's a bit of the introduction of the BEPS, Action Plan 4, in terms of interest deductibility. We'll speak on that a bit as well as an attempt to plug a few loopholes and make sure that the tax net is wide enough. An appeasement of the Aam Aadmi without really disturbing the affluent is what probably I'll summarize it as. So with that, let me go to the expert, Mr. Padmanabhan, for his initial take on how he sees the balance sheet and the macroeconomic situation emerging out of what he's seen out of the budget today. Mr. Padmanabhan.
Thank you. I think one of the important issues that everyone was looking at, or the important issue, was however would a budget be made in a scenario where there is so much of uncertainty. Because the country had still not fully come out of the demonetization. There were many unknowns. And how do you make a budget? And there were a lot of talks about the kind of budget which could be a make and break or break budget as far as India is concerned. I think given that background, one needs to admit that the finance minister has done a very good job and it's a very well-rounded budget. And what was important was to ensure in such a scenario that the budget wittingly or unwittingly does not create any negativity. And that negativity, I'm sure, given the market reactions that happened after the budget, I think most of the things have been taken care of quite well. And in such a scenario, the other thing which is impressive is that when so much or any sort of negativity has not come in, how does one maintain a fiscal discipline? This was a big question mark. Now, everybody thought that given the kind of leeway that was available to the government, there could be a fall guy in the name of demonetization. This fiscal consolidation path would be given a go by. I think it is yes, somebody would say that 3 is a sacrosanct number. 3.2 is not that good, but I would take it that given the kind of uncertainties that we have been seeing around internally and externally, the 3.2%, I think it's a very impressive achievement with a clear commitment that we are going to the 3% number the next year. So overall, I would say that it was a very difficult balancing act that the finance minister had to do, and he has achieved it.
Thank you so much, sir. I think that's a very positive takeaway from the budget. Since you've led various roles in the RBI, including around the payments bank and the digital space, we've seen this thread spreading around the budget this year. Any comments on that part of the budget as you see it?
I think the digitization is something which this country has been following right from the beginning. I think 2 things gave momentum to that. One would be the most important thing being demonetization. The cash was not available, so somebody had to turn to the digitization. So I wouldn't be quite impressed with the numbers that get thrown out during the first 2-3 months. But if we are going to reach there, there are many things that will have to be put in place in terms of both incentivizing and disincentivizing. So incentivizing, I would say you would have to incentivize the digital transaction. But you cannot incentivize the digital transaction in a country where a huge amount of transaction, or probably the most of the transaction, kept done in a cash. So if that is done in cash, how do you take measures to ensure that the cash is disincentivized? So that again is a balancing fact. Now, if somebody says that we can achieve digitization in this country by making every digital transaction at 0 cost to the customer, I don't think ultimately that is going to sustain. Because we need to talk about the granular cost once the infrastructure development is complete. I think in this country, the development of infrastructure for supporting the digital transaction is still an ongoing process. So it was quite important to ensure that, again, a very big balancing act got done in this digitization move also. And most importantly, any digitization in a country as big as India where government is a very important participant in the market. A large number of transactions get done from the government moves or takes definite step towards digitization. And that, I think, is going to be a definite positive outcome of this demonetization, where most of the government transactions are going to go digital. So ultimately, whether, irrespective of the form factor, whether we are going to achieve digitization through the cards or the mobiles or the Aadhaar, I think the country has taken, this is a very definitive movement, I would say, and then what is going to happen is an enormous jump in the digital transactions.
And that can only speak well for, this country as more and more of the economy gets into the digital space. Obviously, there's more contribution to the tax revenues, and that kind of eases the pressure on, as the finance minister said, we have to honor the honorable as far as the taxpayers are concerned. So it kind of lends a good balancing act. And I was also pretty pleased with whether it's about geo data on subsidies or whether it's about using Aadhaar card for payments. I mean, there was so much of that throughout his budget speech, and that's very... So, Abhishek, let me, move over to you. Before we get to 3 or 4 specific tax items which are there, any initial comments on the impact on foreign investors? That's a big chunk of the money into this country.
So thanks, Gautam. We've seen quite a few changes relating to foreign investors, and I think 2 of them stand out because these are things that investors have been asking for over several years. And to that extent, the most important one is the exemption that has now been given for preference shares being converted to equity. There was ambiguity as to whether that was taxable in the first place, but I think now having a specific provision which says that the conversion is not taxable and that the period of holding will go back to the original preference share and so will the cost, is particularly relevant coming at the back of all the treaty changes that we saw in 2016. So as you will recall, with all the grandfathering provisions that came in Mauritius, Singapore and Cyprus treaty negotiations, unless this exemption was given, many of the private equity and other foreign investors would have suffered adversely if they had converted their preference into equity just before an exit or just before an IPO. So to me, that's a very, very favorable amendment that the budget has brought about. As you mentioned, and as was widely expected, the continuation till 2020 of the 5% withholding, not just on ECBs, but also on bonds issued to FPIs, and more importantly, the whole masala bonds being brought in specifically into the statute. So that takes away any discomfort or ambiguity that was available on whether the 5% applies to that instrument as well. On the flip side, I think what's a little disappointing is, Gautam, on the indirect share transfers. While in the speech he talked about it being completely exempted, not just for FPIs, but also for cases where there were redemption of shares at an offshore level, resulting from profits made through an onshore exit. But when we read the fine print, the exemption right now applies only to the category 1 and 2 FPIs, and there is no exemption carved out for private equity funds. So to me, that's a big dampener. While clearly there was a lot of hue and cry after the December circular, one was expecting that there would be a more overarching exemption given not just to FPIs, but other kinds of private equity investors as well. You also talked about thin cap, and I think that's something that will impact investment structures going forward. True to expectation, what's been prescribed is a 30% limit on an EBITDA basis. So essentially, any interest paid to a related party, which is in excess of 30% of the EBITDA, will now be disallowed. And there's also, again, a specific anti-abuse provision that even if the debt is not directly from a related party but is guaranteed by a related party, the thin cap or the anti-abuse provision will apply. The one saving grace is that the additional interest component over and above the 30% can actually be carried forward for 8 years and be claimed as a deduction in future years where it is below the 30% threshold. So overall, I think a mixed bag for foreign investors, a lot of good changes, but a few surprises as well.
Well, thanks, Abhishek. As you correctly said, a bit of a disappointment that we didn't see the changes around indirect transfer provisions for other than the category 1 and 2 FPIs. But I do expect he did mention about a clarification being issued, and maybe it's not an amendment to the Act, and we'll hopefully see something coming out in writing shortly. But while we are on this, foreign investor piece, something that impacts both foreign and domestic investors, Abhishek, is about transfer pricing. And a couple of things which are not mentioned in the budget. Would you like to quickly touch upon that?
So one thing which he mentioned in the speech, and I think that's something that will give relief to, across the board to all kinds of taxpayers, is the relaxation of the domestic transfer pricing provisions. So essentially, he's done away with the umbrella clause of domestic TP. And now the provisions will apply only to cases where at least one of the parties to a transaction is claiming a tax holiday. And that makes a whole lot of sense because that's where there is a potential for abuse. Otherwise, in a non-tax holiday situation where there was a transaction between two domestic companies, there was really no base erosion or avoidance of tax, but it was just adding to the whole burden and cumbersomeness of the compliance. So I think that's a very welcome move. Again, on the flip side, what's been prescribed now is a concept called a secondary adjustment. This was already being done in the cases of some MAPs and APAs, but now it's codified in the law. So essentially what this new provision says is that if there is a transfer pricing adjustment made either as part of an assessment proceeding or as part of an MAP or an APA or as part of the safe harbor rules, then in addition to the incremental tax that has to be paid, the delta also needs to be realized in cash by the Indian company. And if there's a failure to do so, then it will be deemed as though the Indian company has given an advance to its related party, and there'll be a deemed interest computed or imputed on that. Some details are still awaited because they say that the period within which it has to be realized will be prescribed. And of course, what that rate of interest will also have to be looked at. But to my mind, that creates a little bit of added complexity and takes away some of the positive impact that we were seeing both as a result of the APAs and the tribunal rulings in the last few years.
No, that's good. And there was a mention about the authority for advanced ruling as well, and even widening the base of eligibility for being appointed in those posts. So while you're talking of APAs, I would expect there should be some more action on ARs, which really it was, beginning to lose the ability to being an advanced ruling. Timelines are as long as 2 to 4 years before, hearings coming up, but hopefully we'll see more traction on that front. Abhishek, one more thing which kind of ran through the budget, and I know that's been an area close to your heart, has been real estate. And while it's been on affordable housing, sorry, but there have been, other benefits, not necessarily restricted to affordable housing as well. So I'd like to, hear from you, and I'm sure everybody's interested in hearing on all the changes that have happened around real estate.
No, absolutely right, Gautam. I think real estate has always been saying that the budget never addresses their concerns, and this is clearly one budget where the industry can't say that. The big news was affordable housing being given the infrastructure status. Of course, the industry wish list was for the entire sector to be granted that status, but it's been done only for affordable housing. But I think that's a start, and the big immediate benefit, which is not necessarily a tax one, is that it reduces the cost of borrowing because now this becomes a priority sector and so on. So clearly a big boost, and we see in the market today a large number of even the large players are getting into affordable housing. So something that we've been speaking to a lot of CEOs, and they've welcomed this this measure. But I think what is striking is several tax amendments, and most of them beneficial. To me, the big one is in relation to the period of holding. There was a kind of negative arbitrage when it came to land and building, where to qualify for long term you had to hold it for 3 years, whereas shares were 2 years. And that was creating a lot of concern in terms of structures as well as individual buyers who wanted to flip their assets. That differentiation is now done away with, and the period of holding even for real estate assets to qualify as long term has come down to 2 years. So to me that's a very welcome move, along with some of the other measures announced in the New Year speech of the Prime Minister. I think it will all go towards increased demand. But on the flip side, some concern on the provision relating to the unsold inventory and that being treated as income for developers on a deemed let-out basis. While the Finance Minister positioned it as a relaxation, saying that we won't tax you for 1 year, the question really arises is that was that taxable for all these years, because most developers were not treating it as income from house property. So that's going to create a little bit of discomfort and perhaps litigation for this sector. And the other thing is really the clarification on joint developments. Across the country, landowners were suffering because they were being made to pay tax the moment they signed up a JDA and, without even seeing a single rupee in their pocket. There's been a very, very favorable clarification there. It now says that the tax will be paid only on completion of the project, and even then it clarifies that the value on which the tax has to be paid will be the guidance value of the land and no more. So I think, as you said, lots of good things for the real estate sector. We'll now have to wait and see whether some of the unsold inventory can get liquidated rapidly.
Yeah, so reality and reality, right? That's kind of merging together. And hopefully these changes around the real estate sector, it is stated to be probably the largest employment generator sector. And when you talk of volumes, and that's what the affordable housing segment is all about, hopefully this will have a lot of trickle-down impact on the economy over the next 2 to 4 years if this starts really getting into action. A couple of things which were probably not really specifically mentioned in the budget speech, and I'll say slightly plugging the loopholes. One was around, the shares and fair market value of shares, etc. And I'll just like you to also comment a bit on the MAC provisions because there's something mentioned about that. So if you could quickly touch upon these two things.
Sure. I think, as you said, two provisions came completely out of the blue. One was the provision relating to a substitution of the fair value in a transaction of sale of unlisted shares. So essentially what this says is that if there are two parties transacting in shares of an unlisted company, and even if they are not related to each other, the assessing officer now has the power to substitute the consideration for the fair value of the shares. The intention is clear. I think this is all aligned to the larger theme of trying to prevent cash transactions and making sure there's full consideration being exchanged through official means. But I think the ramifications can be quite large, and unfortunately we'll be back to a situation where even on genuine transactions, parties will be now left to the mercy of perhaps having to explain to an assessing officer why the transaction is already at fair value and why it does not warrant an adjustment. Interestingly, there's again no exemption given to AIFs or angel investors. So again, when we look at private equity exits or strategic exits, there are always considerations beyond just what is thrown up by the financials of the company. So my sense is that we should get some exemptions brought into the section, and it should be limited in its applicability to transactions where there is some genuine concern about the value and not made as overarching as it currently is. The other section which comes as a complete googly is the section relating to the long-term capital gain exemption on listed shares. In the run-up to the budget, that was something that was most widely speculated, whether it would be withdrawn. The FM had clarified a few weeks back that that would not be the case, but then there were counter theories as to whether the period of holding would be increased, whether Z category stock exemptions would go away, and there were many versions floating around. And what's come is something completely unexpected. Essentially what this provision says is that if the shares were purchased on or after October 2004, and at the time of purchase securities transaction tax was not paid, then at the time of sale the exemption will not be available. So one simple way to look at it is that if you're buying and selling on the stock exchange, no restrictions, no limitations, nothing changes. But if at the time of buying the shares you did not pay STT, the exemption at the time of sale goes away. Again, one can understand the logic and the rationale, which was to curb malpractices in capital market transactions. But this section only has one safeguard saying we'll prescribe the exceptions to this exception. And really one wonders what that will be and when that will come, because you could have several genuine situations. You could have employee ESOPs which would get stuck. You could have situations of bonus shares. You could have IPO offerings. You could have cases where promoters set up the company several years back and then offload their shares post-listing. So I think while again the rationale is clear, it would be very important for the government to very quickly come out with all the clarifications before that creates a lot of concern in the minds of investors. And this could apply equally to FDI investors, because if at the time of the investment they came through the FDI route, it automatically means they have not done it on the stock exchange. whereas at the time of exit on the exchange, they could get adversely impacted.
That's absolutely right, Abhishek, and that kind of concerned me as well. On a slightly different note, because in a way it may amount to what I may call a retrospective change in the law. Somebody's invested in securities in the belief that when they exit, they will be entitled to a certain exemption. And now you're going back to them and saying, hold on, if you've not paid STT at the time when you purchased, sorry, you're not entitled to the exemption. Probably, even though the intent may be to avoid kind of cases which are misuse of the law, a more smarter way to do it would probably be, with guard in place from 1st April 2017. Those are the kind of provisions that can be introduced and used to curb any malpractices rather than, just doing it across the board. So you spoke of googlies, Abhishek. I'll come back to you, especially when there are any googlies in the questions that will come out. But let me, move on to you, Dharmesh. The budget speech this time was short, and I think one of the reasons for that was the whole absence of the indirect taxes provisions around the budget. So were you expecting the budget not to be speaking about indirect tax so that you'll have a more relaxed 1st of February?
Yes, it was more on the expected lines that status quo would be maintained. And there was no point in increasing the rates, especially when you're coming out of demonetization. And it would be prudent to pass on the increase in rates as we move to GST because the benefit of a more broad-based credit mechanism would be available. So rightly so, it's status quo and expecting GST to be rolled out by 1st July. That's what it would be.
And that's the sense you get when you see the provisions of the budget and the speech and all. They seem to be on track on the 1st of July. I know it's a multi-billion-dollar question.
Yes. Well, the 1st of July or not, but definitely GST is on track because you have maintained the rates on the same lines.
Excellent. Let's hope that comes in sooner rather than later. Well, I shouldn't say sooner rather than later because I think India Inc. needs sufficient time to get ready for it as well, especially on the IT space. Mr. Padmanabhan, sir, just coming back to you, one of the positive sentiments that the finance minister did mention in the budget, there are a few pieces about ease of doing business, and one of them was, the so-called gradual phase out of the FIBB. Now, how do you see that playing out? I mean, do you see that having a good significant impact?
I think probably once the time comes, instead of what we call the gradual phasing out, it will just be shut down. All right. But having said that, I think this direction was taken quite some time ago. I would see this as a continuation of earlier, if you see one of the major amendments in FEMA that was brought out. One of the amendments that was brought out is that the government moved away from capitalization norms under FEMA, saying that as long as there are sectoral regulators and they will take care of the capitalization, we don't want to get into that. So the direction was clearly make things simpler, make things automatic, make things online. And once this happens, then it's a question of interpreting the FEMA because the policy is mostly on the auto route. So the interpreting the FEMA gets done by the Reserve Bank of India. So the people having to go to FIBP or Reserve Bank of India referring cases which they are uncomfortable with the FIBP and then to and fro, that could get completely avoided. So in terms of ease of doing business, to my mind, there's a big step forward. And it'll ensure. And then I also presume that once the FIPP is no longer in existence, the role of the other one, the DIPP, may also may not be much. As a result of which, it's a policy that is set by the government, as they should, and the policy gets driven under the Foreign Exchange Management Act by the Reserve Bank of India. So to the investors, to the people who are coming under the ambit of FEMA, the various stakeholders, I think this will be an important move. And this will definitely ease many operational aspects.
Excellent. So, a lot of positive things coming out in this budget. I'll probably just mention 2 or 3 other changes on the direct tax side which have happened, which I thought are useful, which is useful to know at least. So, one is the dividend distribution tax. There was an additional 10% tax levy on individuals and HUFs for dividends received in excess of 10 lakhs. Apparently, they seem to have widened the net, in which case today or going forward, even trusts which receive this kind of dividend would now be subject to pay that additional tax. And trusts, I think earlier, as per the provisions read, were not covered as far as this additional dividend tax was concerned. So that's one change which has happened. There is, of course, being green, a bit of lack of clarity on what happens on income derived from sale of carbon credits. And there is clarification that that will be subject to tax, but will be subject to tax at a rate of 10%. So clarity, certainty, a reasonable rate of tax, I think that's seems to be a good positive move. Abhishek, just coming back to you, in the run-up to the budget, there's been just so much happening. Long-standing, treaty negotiations have been going on for years, and one must give the government credit for at least putting a finality and an end to it and getting certainty. But of course, developments about GAR poem. So while we are, at this stage, and since there have been such recent developments, such significant ones, any specific comments on that?
Yes, it's interesting you brought that point up, Gautam, and it was quite perhaps not unexpected, but unusual that the government came out with guidelines both on poem and GAR just a week or 10 days before the actual budget announcement. So when it comes to poem, personally I'm a little disappointed because you've brought out the rules of the game 11 months after the game started. And I was expecting that they would actually defer the implementation of poem by one more year, because that would have been the right thing to do, the logical thing to do. Having come out with the rules towards the end of January, you don't now expect people to apply them going back all the way to April 2016. Be that as it may, I think we haven't seen that relaxation. The other thing that concerns me is what was mentioned in the press release in terms of poem being applicable only to companies which have a turnover of more than 50 crores. Again, that was something we were expecting would come out in the form of some amendment or carve out to the poem provisions. That hasn't happened, so one again wonders as to what is the legal sanctity of that 50 crore threshold. Will it really be only a statement of intent through the press release, which of course is good, but will not leave investors and companies with enough clarity and certainty? So to my mind, I think while no one is against the concept of poem, perhaps a deferral would have been a logical thing to do. Similarly on GAR, again, no surprises. I think it was quite well known that it would come as scheduled from April 1. That was the tone of the government through the entire run-up. To my mind, again, the disappointment is not really in the budget announcements, but a little bit in terms of some of the announcements that came out through the clarification last week. Two or three things that stand out there. One is the clarification that even if there is a limitation of benefit provision in a particular tax treaty, or even if there is a specific anti-avoidance rule, GAR can still apply. To me, that's a case of a little bit of overreaching approach, because if there are treaties which have been renegotiated, as you said, with so much effort, and there are thought-through LOB provisions, it would have been rational and logical to then say that GAR will not apply over and above that, but the clarification falls short of that. The positive of that clarification on GAR is, of course, the fact that when it comes to grandfathered investments which are sheltered from the applicability of GAR, the guidelines very specifically clarify that even conversion of convertible instruments into equity or issuance of bonus shares, those will also be protected under the grandfathering provisions. One just hopes now that similar clarifications will also come out in the context of the recent treaty negotiations, so that both these provisions stand in harmony, and again there's no disconnect between what the treaties are saying and what the GAR provisions are saying.
Thanks, Abhishek. A couple of small points on real estate again. One is that if you are paying rent in excess of 50,000 rupees a month, and if you're in one of the metros, well, you get ready to start withholding taxes on that. The second piece, of course, is that if you do have income from house property and you've got interest payouts and you have a loss against that, they're capping the amount of loss that can be set off against other income to about 2 lakhs. Right. I'll just touch upon one last point before we get into the Q&A section, and maybe I'll just ask for any final comments from my colleagues and guests here. If there was one line which really caught my attention and really raised hopes from a tax perspective, it was the comment made by the finance minister saying that he is just looking at introducing accountability on tax administrators, both for errors of omission or commission. As has been recommended by the Shom Committee on the Tax Administration earlier, I think this was probably the most far-reaching suggestion that had come out, and one was hoping and waiting as to when this will be picked up by the government and taken and implemented. Tax certainty, the finance minister himself mentioned in the tax speech about a fair administration of taxes, and I think one of the ingredients of that is this whole piece of accountability. Yes, folks who are not paying the right amount of taxes have to be hauled up, have to be pulled up. There's just no two ways about that. But at the same time, going on this concept of honoring the honest taxpayers and wanting to incentivize people to come into the tax net, I think this point of time of introducing the concept of accountability on tax administrators is indeed very timely. It raises a lot of hopes. The devil would lie in the implementation, and let's see what's in store for us on that specific theme. That could really be a game changer if taken to its logical conclusion. So with that, maybe I'll just ask for one final comment if any of my colleagues or guests have. Mr. Padmanabhan, yes?
Yeah, I just want to flag one point on which I think people have at least reached out to me to ask questions as to how this new payment board is going to work, right? Whether that's going to make a fundamental difference the way in which the payment system is going to function in this country. This was one of the recommendations which was made by the Vatal committee, which was appointed by the government. And I think the way in which it's constituted is more or less on lines of how the government constituted the Monetary Policy Committee. Today, the way it works is there is a separate board for payment and settlement systems, which is a sort of an offshoot or a subsect of the Reserve Bank of India Central Board. The Reserve Bank of India governor, all the deputy governors, etc., etc. There are two external experts who work. Now, given that the payment space is undergoing a fundamental transformation, in what way? There are huge amount or number of non-banks who are becoming very serious players as far as the payment system is concerned. And the second aspect is that Reserve Bank itself induced this change by bringing in the so-called the differentiated banks like the payment banks and all into the picture. We are having a whole host of infrastructures unique in the world, whether it's UPI or whether it's any other thing, who are going to be given the use of these infrastructures. For all these aspects, there was a thought process among the stakeholders, among in the Reserve Bank of India, in the government also, that how this whole payment system administration is going to get revamped, and one of the recommendations was this payment system board. So if you see the fine print, how it's going to work is there's going to be the governor, the deputy governor in charge of payment systems. There is going to be an officer nominated by the Reserve Bank of India who could my own presumption is that it could end up being either the executive director in charge of the payment system or the chief general manager in charge of the payment systems. And there are 3 external experts who are going to be appointed by the government. Now, the first question is, are they going to be the government officials? I don't think that's very clear. Normally, what the government ends up doing is to appoint external experts. Now, is this going to work? Is this going to make things really different? No. I think in terms of discussion, in terms of policies, it could have a more inclusive approach, and ultimately, it remains with the Reserve Bank as far as the regulation is concerned. So for the time being, we need to see how this is going to work out. Whether it is going to take away the independence of Reserve Bank of India was one of the questions that was asked. To my mind, as long as professionals work as professionals and you take views based on professional ethics, I don't think this is going to make any change.
Thanks for that. I think that was indeed a pretty important question that has been coming up. So before we move on to questions from our friends, Dharmesh and Abhishek, any other comments that you'd like to make?
Yeah, I'd like to make actually 2 comments, Gautam, if you allow me. One is just, in continuation of the point that you made on tax administration. The one thing that caught my attention was the phased reduction in the assessment period that has been prescribed. So from 21 months, it will be brought down to 18 months, and then from 18 months to 12 months. Right? So that's a clear example of walking the talk, saying that if there is so much automation and technology being put in place, then you can't have the same period of time being allowed to the assessing officers. So to me, that's a fairly large paradigm shift. The other quick point, again, a topic close to my heart, is on startups. We've seen two specific changes being brought out, one relating to the relaxation on the provisions relating to carry forward of losses and the extension of the tax holiday period. Again, both have been demands from the sector for a long time. But as I've said right from last year's budget, I think it's again a case of missing the woods for the trees, because there are so many ifs and buts and minor conditions that come into the fine print that I don't see any startup benefiting. So I would really hope that at some point they translate this into more meaningful and provisions that startups can really touch and feel, rather than saying, here's something that I can never reach.
Yeah, just a couple of points on indirect tax. Basically, just to summarize his budget proposals, they have been to reduce the duty rates on inputs to reduce the cost, or address the inverted duty structure for select industries like LNG, petrochemicals, solar energy. He has reduced or given exemptions for POS devices and parts required for manufacture of this to promote the digital eco-payment system. And research and development cess has been proposed to be abolished, which would be beneficial for manufacturers and service providers, as R&D cess would cease to be a cost, whereas for traders, it would continue to be a full cost. There have been some other amendments to clarify certain positions on valuation on the property. So all in all, it's been a status quo, but to address some of the immediate challenges of the industry. That's how we would sum up the indirect tax proposals for this budget, and look forward to a GST rollout as per the proposed date. That's what.
Yeah, Dharmesh. So this budget really gives you some more time to focus on the GST implementation and have a better weekend this time. But let's move over to the questions that are coming in from you friends. We have the first question over here, which talks about the 25% rate reduction. Two parts to it. One is saying which year has to be, the turnover for which year has to be considered for the 25% rate reduction. And secondly, also does this development mean that large corporates will have to wait longer for the rate reduction? The answer to the second question is obviously yes. And I guess the finance minister, while balancing the budget out very well, thought it best to defer the reduction of the corporate tax rates for yet more time. He had announced, as you're aware, 30 to 25% over 5 years. Just going by some international developments, I guess this is one of those areas where you don't know how things will ultimately space out. You're probably aware that the UK has been on a constant corporate tax reduction scheme from highs as high as 28% to about 20% now, and there are talks that they're looking at going down to 15%. Right? President Trump, as you're aware, has already announced of bringing corporate tax rates down from 35% all the way to 15% in the US. Now, with these kind of corporate tax rates in major economies, if we are at 34% plus dividend distribution tax, it is going to be a bit of a disincentive for folks to continue on globalization and move away from the localization theme that's happening across the globe. Right? So again, I think it must have been a difficult discussion about how do I balance the budget or reduce the corporate tax rates. On the question on the turnover, the year, my sense, Abhishek, is that this is from the 1st April 2017. Is that right?
Yeah, that's right, Gautam. But I think there's a little bit of detail there. So the way the 25% rate will apply, it applies based on the turnover for financial year 15-16, right? Which means that it must be, therefore, a company in existence as on that year, which is perhaps the reason why they don't have any anti-abuse provisions on splitting up businesses, etc., because it really applies only to companies that were in existence in 15-16, and obviously you can't go back and do all the clever planning that people normally do. The good thing, of course, is it doesn't require the company to remain at a sub 50 crore turnover. So as long as you were 50 crores in that year, whatever you may grow to in the future, as per the provisions, the rate remains at 25%. Just to make a quick observation on the MAT aspect, while he hasn't reduced the corporate tax rates across the board, there was also an expectation that the MAT rate will come down, because really the gap between the headline rate and the MAT rate has become too small. And I think he should have done something on that, and the extension of the credit carry forward from 10 to 15 years, to my mind, is a little bit of a band-aid kind of approach rather than, fixing the problem itself. So, sorry if I'm being a little harsh, but that's my view, at least on the MAT, because 15 years to recoup taxes paid is as good as the money gone.
Yeah, that's a fair statement, Abhishek. The next question is, what's the meaning of redemption of shares or interest outside India in the context of indirect transfer provisions? Well, I can probably just give a little color on that. The reason why foreign investors had gone concerned with the December end circular was around double taxation and about provisions which did not seem to be aligned to the intent behind the indirect transfer provisions. So just to clarify, indirect transfer provisions were aimed at taxing those transactions where instead of transferring shares directly in India, there was an attempt to transfer assets in India by doing an indirect transfer of shares located outside India. Right? The way the law was written up, even in a situation where a foreign investor or a foreign strategic investor exited India by a direct transfer of shares outside India, the money went out into the holding company or the operating company which held the shares of the Indian entity, and subsequently from that level, the money was repatriated back up to the ultimate holding company or operating company, or in the case of financial investors, to investors. The law also suggested that tax was payable even in this kind of cases, which really meant that you paid tax in the first leg in India, and then when you redeem shares of the holding company, you might land up having to pay another round of tax. And if there are 4 levels of corporates in between, the first holding company and the ultimate beneficial owner, the tax could just, go as high as 120%, right? Just to take a crazy example. So the meaning of redemption of shares or interest outside India is that context, that if there's a direct transfer, then the finance minister, I think, has stated in his budget speech that they should clarify that subsequent redemptions of those proceeds should be outside the purview of the indirect transfer provisions. That's also been our understanding based on interaction that we've had with some of the policymakers along with some industry players in the early part of last month when these provisions came out. But fingers crossed, let's wait for those clarifications and let's hope that they are aligned to the intent of the provisions. Let me pass this on to you, Abhishek. Your thoughts on Ind-AS convergence with taxation. That's the next question from our friends.
So this is, I think, again going to be something a lot of corporates will be spending time on. So I think there are 2 changes that are worth highlighting here, right? Firstly, when it comes to the MAT provisions, kind of retrospectively, so it applies for financial year 16-17. They've finally done 2 things. They've changed the reference to the Companies Act 1956 to Companies Act 2013, rather belatedly, but that's been done. And the other thing is all the provisions relating to Ind-AS have come in, particularly relating to the treatment of items that go directly into other comprehensive income. There's a lot of detail to be digested here, but I think the summary is that while they will respect the form of Ind-AS and items that go into other comprehensive income, they have carved out situations that when there is an actual realization of profits by sale of an investment or property, plant and equipment, although that may still be accounted under OCI, it will now have to be taken into account for calculating the MAT. So to that extent, they have implemented most of the recommendations that have been brought about by the committee that was set up to recommend changes as a consequence of Ind-AS and what it would mean for MAT. The difficulty, of course, will arise because ICDS also comes into the picture, and there's been no mention at all either in the speech or otherwise of any deferral, so therefore it will now apply as we speak. And therefore, to that extent, from a compliance perspective, companies will have to first compute their tax under the normal provisions applying ICDS, then bring in the whole Ind-AS concept and compute your MAT. And therefore, I think at least in the initial few years, we do expect a lot of, confusion and some amount of teething trouble. And again, reading whatever I was able to in the last couple of hours, there are clearly some unaddressed issues which hopefully the government can clarify in the coming weeks.
Thanks, Abhishek. As you correctly said, there'll probably be some more things coming out of the fine print reading. One thing that I think we all stumbled upon, and I think there's a question come from one of the viewers as well. In terms of the transfer pricing secondary adjustment, what is the year from when it is applicable? Right. So, Abhishek, I know we've been discussing this, but would you like to take this?
So again, some confusion and perhaps lack of clarity in the language, but the way it appears again is that it will apply to transactions where the primary adjustment is made in financial year 16-17. So of course you have the 1 crore threshold, but it could apply to cases where the primary adjustment relates to financial year 16-17. And therefore again, perhaps a hint of retrospectivity again in this provision. Although when we talk about adjustments relating to 16-17, those will be made a few years hence, and therefore one can argue that it's not really retrospective, but that's our reading so far.
Good. Next question is on SEZs. What's the impact of budget 2017, both from a direct and indirect tax perspective? I didn't hear anything about it, but maybe I missed something. Dharmesh, Abhishek?
I don't think there's any specific indirect tax proposal for SEZs. There are some clarificatory amendments for EOUs, per se. Yeah. That's it.
Sure.
So nothing again specific, although as some of you will recall, last year we had a sunset clause being introduced both for developers and for units. And that was really a part of the larger roadmap for reducing the corporate tax rate to 25%. So as a first step, they said for developers you have a 2017 sunset, and for units you have a 2020 sunset. And therefore the expectation was that if the corporate tax rate reduction is deferred, then perhaps these sunset dates will also move a year. But that hasn't happened. So therefore, as we speak, we still have March 31 as the deadline for developers, so hardly any time left. And for units, you still have 3 years, and I don't think this will move at least in the near future.
Sure. The next question is more on the individual salaried folks. The question states, as against the much touted talk about giving relief to taxpayers as against tax evaders, it is net negative for individual salaried folks. Measures aimed at broad basing the tax have not come out clearly in this budget. What is your view on this? As I mentioned earlier, I think one theme clearly coming out from this budget is the focus on, if I'll say, tax inclusion. I wouldn't say the measures, nothing's been done. For folks, for salaried people or anyone having income up to 5 lakhs, is almost half the tax rates, from 10 to 5%. And apart from that, I think even corporates having a turnover of up to 50 crores, the tax rate has been reduced from 30 to 25%. So, to my mind, this budget contained more the carrots of getting the tax evaders into the tax net. The stick was demonetization, and to some extent, a stick would be the GST, because by default, if you're anywhere in the chain which is covered on the GST net, you'll much rather make sure that you've got everything disclosed. So that's my 2 bit on this. I thought it's well thought out, well placed. The timing is good for all of this stuff. Coupled with the softer aspects of saying we're getting in accountability, we're reducing scrutiny timelines, we're not going to touch you for the first year unless we've got some specific information on this. That's my 2 bits on this. Abhishek, would you like to add anything?
Yeah, I'd just like to add one point, Gautam, which is that while clearly it hasn't done much to bring in new individual taxpayers into the net, there are several interesting other anti-abuse provisions that have come in. And what strikes me is the provision relating to the deemed gift under Section 56. So again, earlier that applied only to individuals, and again it applied to companies and firms only to the limited extent of shares. And again, there was a little bit of misuse in terms of whether trusts were covered or not. So what they've done now is they've sort of collapsed both the sections into a single section, and essentially they're saying, irrespective of the status, any gift received, whether cash, movable property, immovable property, anything which is other than for fair value, now will be treated as a gift. So I think that's a significant improvement in the way the provisions exist currently from an anti-abuse provision. Of course, there's always the mischief where it catches genuine transactions, and hopefully as long as those exemptions stay, it should still meet the objective of bringing more transactions into the net.
Gautam, just I want to add
Sure,
on.
please.
I think from a completely, I mean, I have no clue on this tax practice and all these things, but I think two important developments which need to be noticed, where even from the speech that the finance minister made, there is hope that this tax net is going to get widened, is on account of two counts. One is, if digitization does happen, then it's going to make these transactions auditable. So yes, one, it's not easy to evade, so they are going to be brought into the tax net. The second is the kind of investigation that is going on about the monies deposited on account of demonetization, whether these people will have to be brought into the tax net. So while I completely go along that there have been no specific measures, but probably there is a clear expectation on account of these two that the tax net is going to get widened.
That's right, and they are, as the finance minister suggested, using data mining tools to kind of address the problem, very specifically rather than just it being a wild head-on. Next question is, how do you see the impact of budget on financial market, including banking sector? I think quite a few things over here. One of the 10 themes that he started the budget speech on was on the financial services sector. Apart from tax, I think a host of measures that I do recollect he mentioned in his speech included, time-bound listing of public sector enterprises, included a bit of bank recapitalization, listing of asset reconstruction companies and securitization trust receipts. And I think the intent was to make it more simpler and more broad-based to raise capital, which can then be used to kind of refinance this whole, NPA piece. He also spoke about the spot and commodity derivatives, and specifically on tax, of course, the whole interest deductibility issue that Abhishek referred to in terms of the BEPS Action Plan 4, of that interest being restricted to 30% of the EBITDA. My recollection of the reading is that there is a specific carve-out for banks from the applicability of those provisions. Not that banks tend to have cross-border transactions of that high amount, but I think it's good for the banking sector that they have been kept out of those provisions. Of course, the slightly higher limit on NPA deductibility is again a welcome measure. So, other than real estate, if you have to really put your hands on one sector which has found its mention across this budget has been financial services and banks. But let me just quickly, pass this question on. If Mr. Padmanabhan, you.
Couple of points. I think as far as the financial market is concerned, clearly there are no negativities. That's very important in a scenario like this. Where there has been a great positive announcement, probably not. But in terms of if there is nothing also, then the question is overall budget, does it ensure macro stability? That's important for the financial market. I think overall there is a clear indication that the government is very conscious about the macro stability and they are moving ahead on that path. So that's, according to me, a very positive thing as far as the financial market is concerned. The banking sector, lot of talk about the bad bank, and I was personally quite apprehensive about this bad bank, because the bad bank is something, as it looks to me today, is a bad idea. Because first of all, who is going to fund this? And secondly, if there are funds already available in the system to fund a bad bank, why don't you fund the banks? Right? So I think what is important to me is they have kept the banking scenario, let's say, they're coming back or coming out of the problems very simple, straightforward, no complications introduced into the system. They said, as and when the bank needs capital, we stand ready to capitalize the banks. To me, that's a very positive, because they are following a very straightforward path. Because the bad bank, first of all, where are they going? Where are even the ARCs are not able to find enough capital. So where is the money going to come from? So this was always in my mind. I think I was very thrilled that that has not come about.
Thanks. Very well put, sir. We're exactly 59 minutes into this session. It was a 60-minute slot, and we'd like to be on time. So with that, I think I'd like to thank all of you all for joining into this session. I'm told we've got hundreds of viewers clogged into this webcast. Special thanks to Mr. Padmanabhan for taking time out and sharing his views based on the huge and massive experience that he has from a very different perspective that what Dharmesh, Abhishek and I carry. So thanks Dharmesh and Abhishek, and thank you so much sir for joining us today. I'm sure there'll be more questions coming up from your side. Feel free to reach out to your PwC Connect, and we'll be in touch as further details unearthed. Thank you so much. Have a good evening and a great week. Thank you.